which is required, okay, for something like that. In India, very shortly, you will now be getting something which is called REIT, R-E-I-T, real estate investment trusts. So what these guys are going to do is they are going to buy the real estate and lease it out to you, okay. So what it does for you, it just releases your, cash flow towards acquiring a, building, which is huge, okay. So the first, hospital chain which has gone and done that is Fortis. So entire group of Fortis hospitals are bought by a REIT, so the 15,000 crores suddenly released to, Fortis for investment. So these kinds of newer concepts are coming up, but till they come, keep this in mind in terms of cash profit and book profit. And you should always look for this, how can you make a cash profit? Book profit should not bother you too much. Check for the profitability with industry benchmarks. Make statements for 5, 7, and 10 years, to understand that how it operates. And then there's something like a break-even analysis. I will talk about it. And there is something called as internal rate of return. And there is something known as DSCR, debt service coverage ratio. Just for you to understand in layman's language, if this IRR, which is internal rate of return, is less than the rate of interest in markets. So if you're borrowing money, you're paying 13%, 14% interest rate. If your IRR of these projections that you make is more than 14%, okay, you should go for the project. Because what it means then is whatever money you are investing today is going to get you returns higher than if you put money in fixed deposit or if you take money from the market. Okay, so that's what you should just understand. If your IRR of your project is more than the rate of interest, you should do the project. Debt service coverage ratio is, something to do with how able you are to cover your debt, right? So anything which is, downwards of say 2 or 1.8, you are a little on a shaky kind of a ground. So just remember that how to calculate that and all is not our job. That's, the financial experts to do that. A little bit about, this break-even analysis and sensitivity analysis. This is something which, we should do, and if you pass this test is what you should, aim for doing a project. If you are shaky on this, then generally not advisable to go for it. What it means is, it is also called as a what-if analysis. Okay, sensitivity analysis is also called as a what-if analysis. What it means is, what will happen to my project if the cost overruns by 20%? Okay, so you will have a spreadsheet in the capital cost. You just increase the cost by 20% and see how the financials behave, because this spreadsheet at the end of it becomes interlinked, right? What will happen if means of finance changes as debt equity ratio? So suppose you were having a debt equity ratio, suppose you had a project of 10 crores and 5 crores, was the debt and 5 crores were the equity. What happens if, because you may not be able to raise 5 crores as your own capital, right? So you may say, what if I go for 6 crores loan, right? So then you see, put that figure and see how it behaves, because the moment loan goes up, your interest burden will go up, right? So that parameter. Then Forex, foreign exchange fluctuation, because I think most of the consumable that you use are imported, am I right? Yeah. So if foreign exchange, currency fluctuates, your fortunes also fluctuate with that, right? The only hospital which I have seen in India which has a very robust costing mechanism is Hinduja Hospital in, Bombay. They have always their, hand on the pulse. They exactly know what their test is costing them, okay? And their rates vary by foreign exchange fluctuation. So if dollar to rupee went from 54 to 68, say about 9 months ago, there were a lot of people who made losses, if you didn't adjust your pricing, okay? So that's why if you, do some currency fluctuation in your sensitivity analysis, you might be, better off. Capacity utilization changes. So say suppose I told you in the beginning that you do every project at 100% capacity utilization, and then year 1, year 2, year 3, year 4. So you change that. You say instead of 40% capacity utilization, what will happen if I start with 30%? Because it may happen, that you may not be able to do 40% collections, of investigations. What happens then? Hike in salaries, by say 10%. Maybe you have not budgeted for it. Let's see what happens to that. Impact of phasing the project. Many a times when you see that, it's difficult, you say that, no, let's put this one first and the later, maybe buy that other equipment later. What happens? So by doing these kinds of things, you should come to a worst case scenario. Okay. So in that worst case scenario, if you are able to get the confidence, then in a worst case scenario, I can maybe mortgage my house or, sell this piece of land or, maybe get in some money from somewhere and I can still survive. Okay. Then go for the project. If you are shaky, so maybe you downsize the project, maybe you think of bringing in an investor, maybe you think of reducing the debt, but don't go in for it unless you are 100% sure after doing this sensitivity analysis that yes, in a worst case scenario also, I am able to pull this off. All right? That is extremely important. If you don't do this, then things can go haywire and there are umpteen number of healthcare projects which are stuck because someone did not do a very proper, financial kind of a modeling. Structuring the project finance is generally based on the sensitivity that we just undertook. So, select the best mix as you can. So, what are the various types of, so debt equity ratio, okay. You could even look at donations if you are looking at a charitable trust-based, laboratory. Debt could be in Indian rupee or foreign exchange. 100% foreign direct investment now is allowed in India in healthcare. Owned versus leased option. This is the commonest, because in Indian psyche, I'm a Maharashtrian and it's been generally been taught to me that, you should always play safe. Not taught to me, I think comes through my genes. But I think a leased model makes ample, sense. Rather than blocking your capital, I did that. I run a company, I brought in a private equity investor about 6 years ago, and I did the foolish mistake of putting that entire private equity into, buying real assets across India, and we have an office in Dubai also. So we bought, real estate. And then if I look back, I think I should have used that money more to maybe marketing or, doing something else, getting on better people on board or something like that. So this is a very tricky, kind of a situation. But I would today, if you ask me, I would look for a leased, model if it is available. It is much better than owning the premise. Equipment lease, reagent rental models, you are better, people to talk on this than me. Franchise departments, if there are anything that you think can work like that, look at that. It's not a bad option, to go with. There are many hospitals, which do that, which operates, say, Nephro Plus is the equivalent. I mean, you are also running a lot of laboratories in hospitals. So Nephro Plus is doing a similar kind of franchised kind of thing. Dental chains are doing that, now. Then comes the, question of venture capital versus private equity. So venture capitalists generally will promote a new concept, okay? Whereas private equity will invest in something which is already existing, and is looking at scaling up the operations. There is a difference between the two. So venture comes as an angel investor, which is a first time, for a first time kind of a project, whereas private equity will come in when you're existing and looking at scaling up. Because always remember, private equity funds invest in you to cash out. They never come in with you to stay. 5 years and 7 years is the horizon, and they will look at exiting. They are not with you, to stay in the longer run. Whereas, a strategic investor will be willing to stay with you. Say, Azim Premji Foundation is there as a strategic investor. They are not like private equity kind of fund. So you need to understand that, before you take on a private equity or a venture capital or look at a strategic investor. Strategic investors generally are better options, because the amount of load that will come on you will perhaps be lesser. Okay. So I think, that is, moral of the story is that plan well before you execute. Okay. If you plan well, you are half done. All right. So don't, generally leave loose ends here and there. Okay. I hope I made sense, though it was completely different than what, the entire conference is about. Thank you very much.